Hey friends, welcome back to the channel. I hope you guys are having a wonderful day. Today we're going to cover a topic about analyzing stocks and more particularly using financial metrics and financial ratios to understand how a company is doing and to make a better investment decision. And I know that this topic might be a little bit daunting for new investors. And to be honest, even as a finance graduate, it took me a while to understand some of these ratios and really apply them into an investing scenario. And today we're going to cover the top 5 most important financial metrics and ratios. I'm going to do my best to simply explain them as well as help you understand why they're useful and as well how to apply them next time you guys are making a financial decision. So if that sounds interesting, let's get right into this video. So the first financial metric that we'll be discussing is the earnings per share ratio, or EPS. Now, EPS is essentially a company's profit divided by the number of common shares outstanding. It's important to understand that different industries in the stock market have different relative ranges of EPS that deem how healthy a stock should be or what's normal. As a result, when we get this EPS number, we could actually compare it within the company itself to kind of gauge how much the company is worth in the eyes of a shareholder, i.e. us. Generally speaking, a higher EPS is referring to a company that is more profitable, but we also have to keep in mind that sometimes companies would increase their EPS for a relative number of reasons. The formula for the EPS is the company's profit, or its net income minus its dividends, divided by the total number of common shares outstanding. Guys, so the second financial metric that we'll be going over today is the price to earnings, or PE ratio. Essentially, the PE ratio allows us to understand what the valuation of a company is worth based on its market price. We can use this PE ratio to compare different companies together for an apples to apples comparison. We can also use the PE ratio to compare a company against its general market outlook and general sector in order to figure out how it's performing based on an average of multiple companies. It's important to understand that just because the PE ratio is high doesn't mean that the company is worth more. In fact, it actually might just be overvalued compared to its competitors in the same market. To understand the PE ratio and its formula, it actually builds upon the previous ratio, the EPS ratio that we talked about. Essentially, the formula is just taking the market price of a company divided by its earnings per share. That number gives us the PE ratio. All right, so the third financial metric that we're going to be talking about today is the dividend yield. Now, this is personally my favorite financial metric, and you're going to see why. Essentially, a dividend is a cash gift that companies will give investors as a way of saying thank you for supporting them by investing in their company. Now, not every company will pay out a dividend. In fact, only companies that have a reputable track record and have been doing well and have extended profits over a long period of time can afford to pay dividends. With that being said, there's also certain tradable instruments that focus on dividends, including high dividend growth ETFs, real estate investment trusts, and business development companies. The formula for dividend yield is actually quite simple. It's just the dividend divided by the total market price of the company. All right, guys, so the fourth ratio that we're going to be taking a look at today is the working capital ratio. Essentially, this ratio tells us a little bit about the financial health of the company, more particularly its ability to pay down its short-term debts. Now, most companies nowadays will use debt to basically run their business. It's just a natural part of the way corporations work. And it's important for us to understand how capable a company is of leveraging its assets and using that to pay off its debt. Essentially, this concept is called liquidation or liquidity. And this process is essentially taking a company's current assets, transforming that into cash, and then paying off any of its short-term debt obligations or long-term debt obligations as it needs. Now, when we take a look at the working capital ratio, it's actually quite straightforward to understand. It's essentially the current assets of a company divided by its current liabilities. And this will give us a rough indication of how eligible the company is of paying off its debt if it chooses to. And more importantly, the financial health of a company, because it allows us to basically understand how much cash reserves it could potentially have to pay off any debt obligations. Now, if we take an example, if we have company A, which has $10 million in current assets, be it any machinery or any like IP or anything that they could use or cash, And then they also have $5 million in current liabilities, which are things like short-term debt obligations or any like IOUs. Essentially, their working capital ratio would be 2-to-1. Now, this sounds like a pretty good ratio, but it's also important for us to consider how the overall industry is doing before we take that 2-to-1 into consideration. Once we have different numbers of working capitals around different industries or within the industry in general, we can actually determine whether or not this company is in a good financial situation or not. But either way, the working capital ratio is really important for us to understand as investors. All right, so the fifth financial metric that we'll be taking a look at today is the debt to equity or DE ratio. Essentially, this ratio tells us how a company is doing in terms of its borrowing situation. Now, when a company needs to borrow or raise money, it usually goes two routes. You could either go the traditional route and go to a bank and apply for a corporate loan and take out money that way. It's going to be considered under your total liabilities. Or you can go to the stock market route. You could either issue an IPO or you could actually issue new stocks. And essentially, this will count towards your total shareholders' equity amount. Now, the decision between raising money either traditionally or through the stock market is a decision that the company itself has to make, and it's usually one that is geared towards the financial situation of the company. Using the DE ratio, we can actually understand how a company is doing in terms of its debt obligations, and more particularly which avenue it decided to choose. Now, when we take a look at the DE formula, it's actually quite straightforward. It's essentially a company's total liabilities divided by its total shareholders' equity. Now, when we take these two numbers and we get the final result, we can actually use this to compare against different competitors within the same industries or within other industries as well. Now, generally speaking, a DE ratio that is higher basically corresponds to a company that is a little bit more levered or a little bit more risky just because they take on more debt. But a DE ratio that is lower is usually considered one that is more safer. But it's important to understand that different industries have different averages and different norms for DE ratios. So before we judge a DE ratio based on the total value, it's important to consider how it's doing compared to its peers. All right, guys, so that was it for today's video. I hope you guys learned something new about financial ratios and financial metrics. I know that this topic can be extremely daunting for the new investor, but by making this video, I hope to equip you with some knowledge next time you're looking to make an investment decision. So just to recap, today we covered 5 of the most important financial metrics, including the earnings per share or EPS ratio, the price earnings or PE ratio, the dividend ratio, the working capital ratio, as well as the debt to equity ratio. And hopefully with these 5 ratios, the next time you guys are looking to make an investment decision, you guys will feel more equipped and more knowledgeable, and you guys could analyze different companies as well as their competitors to make an informed investment decision. So if this video helped you in any way, feel free to leave me a like and as well as leave a comment letting me know what you guys would like to see next. And as always, thank you guys so much for watching, and I hope you guys are having a great day. See you.